Hey, welcome. This is Jerry over at Wealth Dynamics coming to you with a really quick webinar on how to take loans against your sacred account. This is something that really needs to be understood. It's a function of a sacred account. And if you don't know what a sacred account is, a sacred account is an account that I set up for my clients using life insurance. And it's an account where you keep your saved income for the sole purpose of investing in cash flowing assets. Okay, it's secure. It has a great dividend rate, grows tax free. But I'm going to go over how you use the account. If you're actually trying to access money, you're going to use the loan feature. So real quick, I'm going to share my screen here and we're going to go through this together, right? Now I've got a couple things pulled up. Okay, first thing you're going to see is the policy loan, okay? So the policy loan, basically when you're looking at a policy loan, that's how you access the funds, right? So when we were doing a policy loan, you basically have money in the account. So you've got dollars in your cash value, dollars that you've been contributing dollars that are growing. And when you're ready to access those dollars, there's two instances you should access the dollars, okay? You should take a loan if you're going to invest or if you're going to pay off debt. Okay, those are the only times you should take a policy loan, okay? And I'm going to explain why, okay? So when you're doing a policy loan, the reason why you do a policy loan, you've got money in the account growing, right? And that money is earning, a 6 to 8% gross annual dividend. If you're earning a dividend and you're growing your account and you've gained money and you pull the money from your account, what's going to happen? The IRS is going to tax your account, okay? So you don't want to pay taxes on this money. If you withdraw it, you will. The way around that is you borrow against the account. Okay, you borrow against the account. The reason why you borrow against the account is the IRS cannot tax a loan. They can tax income, they can tax the capital gain, they cannot tax a loan. So by borrowing against the account, you avoid taxes and you can keep your returns and you can go invest with it, right? All right, now the other thing that borrowing does that's kind of cool is because you borrowed, you took a loan, your money never actually left the account, which means that you're earning a 6 to 8% dividend. Okay, so if you're making a 6 to 8% dividend, your money's still technically in the account, and you just did, let's say, an investment deal where you're earning 12%. What's 12 plus 6? That's 18, right? So you're making an 18% total return on this because of the fact that your money's still growing in the account. All right, now what's the catch you're asking? When you borrow the money, you will pay interest. Okay, so you're going to pay interest on the policy, and that interest, I'm going to go ahead and clear our board off here. That interest that you're going to pay is simple interest, meaning it does not compound. Okay, and it's due annually, right? Now, how much is the interest? That's the main question, right? So you're going to pay interest. That interest is going to typically be 5 to 6%, and it's interest only, so it's simple. It does not compound. Interest only, right? Which would mean, just for example, let's say you have a 6% interest rate. You had 100 grand you borrowed. That means that you're going to pay $6,000 in interest to borrow that 100K, right? Now, nobody likes paying interest, but you're paying interest instead of taxes. Okay, now the other thing that you're focused on here is this is not an account where you just let the money sit. All right, so we've established that there's interest. You're going to borrow against the account. We've established that there's interest. So if you're earning 6 to 8% in dividends, and if you borrow, you're going to pay 5 to 6. That means you're pretty much going to have one of two things happen. Your dividend and interest rate is going to be at a wash, meaning you earned 6, you paid 6, or you could earn maybe 1% or 2% of extra profit, meaning you borrowed at 5, but you're earning 6. But the thing that you need to realize is what you borrow for is the thing that should cover the interest. What that means is if I'm paying 6% interest, I never borrow for something that's not going to earn more than 6%. Okay, I'm never going to borrow more or sorry, less than 6%. So if I'm doing a real estate deal, it needs to earn at least 6%. Okay, if I'm paying off debt, the interest rate on that debt needs to be at least 6%. Okay, if those aren't the case where you're making at least 6%, then you should not borrow. Okay, so when we're looking at this, we have talked about what is a policy loan, right? So we've handled the what is a policy loan. Let's talk now about when do you actually do one? Okay, so when you do a policy loan, again, you're going to use debt pay down as one of the things you're going to use a loan for. The other thing is going to be investing. Okay, if it's debt, let's handle the debt first, right? So if it's debt that you're going to borrow this money for, then the when is when your cash value is equal to your smallest debt balance. Okay, you guys have seen the Dave Ramsey debt snowball before, right? Where you pay off your smallest balance to largest balance, and you pay it all off till it's gone. You wipe the debt out. Awesome method, but the only mistake or problem is if you pay it all off and you put all your money towards it, when you get done paying off your debt, you're broke. Then you end up back in debt. That's why there's so many people that are stuck on that step, right? So when your cash value is equal to your smallest debt balance, you will borrow that money, okay? And that money is going to cover your debt. You'll wipe off the debt. The old payment that you used to pay, your old payment is now going to pay back your cash value. Okay, so if you had let's say it was 10 grand in debt and you were paying $300 a month on it, that $300 a month that's now freed up is going to pay off your cash value loan. Okay, and I'm going to break down for you why. You don't want to just leave your loans outstanding, right? You are paying interest. So if you can reduce your principal value, that means you can actually lessen the interest you're paying and increase the profit spread between your dividend and your interest rate, right? So if you're paying a 6% interest rate on $10,000, that means that you're paying 6% of 10,000. I think that's $600, okay? And that money is interest. Now, if I have, like we talked about, this payment, this $300 payment that I have because I freed up my debt, if I start paying that towards my cash value loan and I start reducing this 10 grand, the 6% is calculated on a daily basis on the outstanding balance. So what does that mean? If I'm reducing my balance, then I'm not actually going to pay $600 in interest. Okay, let's say I paid my balance down to 5 grand because of my cash flow. Okay, so I've paid my loan balance down to 5 grand. That means that my payment on this is only $300 as well. Okay, so I have $300 a year interest due on this loan because I've been taking the old debt payment that I used to have that I've now freed up to reduce my cash value balance. All right, you can do the same thing with real estate. So if I invest in a real estate deal, right, and I have 100 grand that I put into a real estate deal. So I had 100,000 in cash value, and I go take that 100 grand out and I put it into real estate, right? And I'm earning 6 to 8% in dividends because my money still grows, but I'm paying a 6% interest rate and my real estate is earning 12. Okay, well, 12 on 100,000, that's going to be $1,000 a month in cash flow. Right? So $1,000 a month in cash flow. I should take that cash flow and I should pay my loan off early. Okay, the reason why is, again, the interest is based on the outstanding principal. So if I reduce the outstanding principal with my cash flow, I actually lessen the interest paid, which means the difference between my dividend earned and interest paid becomes larger. Right? Now, when you're looking at loan repayment on a cash flowing deal or when you've paid off debt, I want you to think of it as the same thing as saving. Okay, loan repayment equals saving. What would be the alternative? You would take this $1,000 a month, you'd stick it in a bank, and it would sit there. Okay, What's the difference between that and paying off a cash value balance with money that when you pay it off, it's available right away? You can pull it out just like you could the bank. It's the same thing, right? So that's the when you have enough money to either invest in a cash flowing deal that will make you more than 6%, or you have the ability to pay off a debt, smallest balance to largest balance, using the Dave Ramsey snowball method, right? But we're using life insurance instead. We're going to basically pay off the debt, use the cash flow, pay back our life insurance, keep saving it till we can handle the next debt. Then we'll pay off the life insurance again, and we'll repeat that process. Yes, it will take a little bit longer, but you'll actually have money growing for you. By the time you're done, you'll have all of that paid off, okay? So that's basically what we're looking at there. Now, the next thing is the how. Okay, how do we actually access policy loans? The next thing here is the how. So in order to access a policy loan, you're just going to basically log in and take a loan out on your policy. This is the most simple part, okay? Everything is computerized. You have an online login. You go online, you request a loan. Okay, so when you request a loan, basically that's going to be, a loan that you're going to get from the life insurance company. You don't have to qualify. There's no credit involved, nothing like that. Okay, so you're going to request a loan. That money is going to go into your bank, whichever bank you have linked to the account, and you're going to have that available now for investing, paying off debt, right? It usually will take about 2 weeks, I would say a week to 2 weeks to get the money. So you need to give yourself plenty of lag time ahead of time. So it's going to take 1 to 2 weeks to get the money, for them to transfer it to you. In some states, they can do that direct deposit. Some states, they do have to mail it to you. So you want to kind of plan for 1 to 2 weeks. And basically, once you have that money, you're good to go. It's cash. You would spend it just like cash. You would invest it just like cash. Okay. So that's basically how the policy loan works. Now, if you're watching this and you're interested in learning more about this concept, I want you to go to www.sacredaccount.com. Okay, sacredaccount.com. Okay. Now, if you go to sacredaccount.com, you'll see more information like this on the Sacred Account. That's the website you want to go to. Now, I'm going to go ahead and tune out on this. I want to thank you for watching. If you have more questions on this, you can reach me at jerry@wealthdynamics.com. Okay, and again, that is wealthdynamics.com. And I want to spell it out because we spelled dynamics uniquely here, DYNAMX.com, jerry@wealthdynamics.com. Thank you for watching. Make sure you like, share, and subscribe, and I will talk to y'all soon.